Hello, everyone, and thank you very much for joining us for this afternoon's Nasdaq Dorsey Wright webinar on score-based solutions, specifically looking this afternoon at how we apply the fund score method through the Fsm models, fund score method models that are available here on the Nasdaq Dorsey Wright research platform. My name is Ian Saunders, and I'm joined this afternoon by Steve Raymond and Eric McArdle. And last week, we initiated this fund score discussion in touching on how the fund scores are constructed and how we apply that construction to some relative rankings that we have on the system on the asset class group scores page. I'm going to provide a brief overview here before we dive into the models on the background of fund score for those of you who might not have signed in to that webinar. So the fund score is going to be a similar methodology to the technical attribute approach that you may be familiar with, but it's going to be looking at things a little bit differently. It's going to be a scoring system that's, again, based solely around ETFs and mutual funds. So all ETFs and mutual funds will have a fund score that goes from 0 to 6, with 0 being the worst and 6 being the best. This scoring system is split off into essentially 3 main areas. There are a total of 19 different factors that we're looking at for the fund score calculation, again, split off into essentially thirds, with each third getting about 2 points. The first third is going to be looking at how strong is this fund trending in and of itself, looking at trend analysis. The second third is looking at the relative strength against the market. And then the final third is looking at relative strength against its peer classification. Again, each of these 3 thirds for the score get about 2 points, adding together to a total potential score of 6 points. The fund score is going to be very flexible in terms of its scoring system by nature of each of those different factors that we're looking at. So you will see it displayed on the system going out to the 100th place. It will be something that will likely change just about every day. It might change just a little bit, maybe moving from a 4.01 to a 4.03, or it could change quite a bit more depending upon the movement that we see going on in the market for that particular day. But the important thing to keep in mind is that it is a very flexible scoring system. It is something that does adjust as the market changes. And one of the reasons that we see that is because of the combination of both absolute and relative strength in the scoring system. Again, that first third that we touched on there, looking at the trend analysis factor of the fund score, does lead it to be more variable and more flexible in terms of where it moves in correspondence there with the broader market movement. And so this has led us to take these scores and apply them through some various different ways on the platform, but looking specifically today at how we use these scores in some of the models that we have on the Nasdaq Dorsey Wright research platform. So on the platform there, we have a variety of different models, over 100 different models in total, some of which are going to be focused around what we call a fund score method. And it's going to be looking to apply these fund scores, taking advantage of that combination of absolute and relative strength to get at a rotation-based model here. So for some further background on the origin of the FSM models, why they were created and how they were created, we're going to throw things over to Steve here to talk about the background there of the models themselves.
Thank you, Ian. Yeah, as we kind of remind ourselves, some over a decade ago, 2 decades ago, the grand idea in those days was inventory management. And I think that the scoring system at Dorsey Wright, was a win. To grapple with that idea. This is kind of that pre-model era, where the inventory management, you selected funds or you selected things that you need, you're trying to fill an allocation, you're walking out the door with something that looks like an asset allocation pie. And I think that people from different firms inside or outside the discipline of Dorsey Wright, still, approached it this way, where you're looking for the best funds that you manually insert into, an allocation, and then you go visit with your client. Keep in mind also in those days, we also made great strides with the matrix products and the matrix invention. And in those days, if I'm not wrong on this, you could put about 20 assets in a matrix to get a ranked ordered list that could help you there. And I think that, with the fund score system, you had the ability to really do, hundreds of funds at a time. So there was a push to say, hey, we need relative strength in the the fund lineup where we have to manually go and put these in. Now, that led to this idea. Well, if we're using fund scores manually on some frequency to create a new lineup for our client and the asset allocation, what would it be like if it was automatic? And to give you kind of a of a contrast, we kind of already knew like a Morningstar rating system was gravitated in pretty substantial amount of history. There were some other dynamics that they follow that technically we don't, and they don't follow technical analysis, at least in those days, at all. And the idea is that we kind of knew that the Morningstar rating system might not work very well at an automated model at all. But I think that created a space, the thought, the idea, hey, we could make progress in this model automation where, the rules-based model, the rules-based and the scores and the relative strength and the trending and all those things encapsulated in there, could work through an inventory all by itself. And I think that was the revolutionary idea. And of course, that you could say, evolved into what we would call, FSM, fund score method, where it's really the fund score, which is the dynamic trigger. In fact, the main trigger, you could say the only trigger, after you selected the inventory to go in a model type of approach that you want to talk to your client about, it's really that inventory, revolving through the inventory over time. That's the key concept there. And of course, the inventory could be updated, every year, every 2 years, or every 3 years. But really, it's the fund score that's the guidepost that will give us a monthly or quarterly, reading in there. And I think that is a main, evolution of how Dorsey Wright got in, along with the matrix, got into the model business, the rules-based model business. And of course, as you all know, as advisors, the industry itself, finally adopted in large part this rules-based modeling concept. They approach it in different ways. Dorsey Wright approached it 100% technical analysis, 100% relative strength price trending of how things are working in the market. And of course, with that whole concept, we did work with time-based model updating. And I always favored, among other things, among monthly and so forth, the seasonality quarters. So the seasonality effect is really a 2 half-year places in the market where timing seems to make a difference in price returns, November to May and May back to November. And what we did is we broke that up into 4 seasonal quarters, as we've covered before in an earlier episode. And so this combination of the seasonal quarters with the fund score, I think in those days was revolutionary, and I still think it's revolutionary because what it does is it gives you a simple way to say, hey, let me describe to my client what I'm doing and when I'm doing it. And it seems to catch a very good response from the client, as well as your firms or compliance or different things. Is that we're behaving within a context in most cases to a quarterly type of update review. Here's the reasons we like these funds, these mutual funds or ETFs, and here's the reasons why we don't use others. But it comes down into a pretty simple, compact story, which I think is logistically very easy to run. Keep in mind that it's one thing to say, yeah, I have 2,000 funds available to me. Let me go out and go hunt them down on a monthly or quarterly basis. That's actually a hard do. I think what you want to come back with is say, hey, I've got a good inventory. It's covering all the asset classes, in time, and that's what we, want to focus on is the logistical ease of such an apparatus. Thank you, and back to you.
Wonderful. Thank you there, Steve. Definitely some wonderful background there on the history of the models and how they were how they're constructed. In terms of furthering that conversation around the construction of the model, there's a couple different aspects on the platform that you can utilize to get at a reference point. And one of those in particular is going to be called the Fsm Model Guide, which provides some framework around the structuring there of the models that I believe Eric was going to go into a little bit more detail on here.
Excellent. Thank you both. And with regard to that FSM Model Guide, for those of you following along at home, This is accessible under the Resources tab, Prospecting, and then Fsm Model Guide. And this is designed to give you a one-page view and your clients a one-page view of how these models are constructed. What do we do in terms of thoughtfully putting together inventories? How are they managed from a number of holdings standpoint? How often are they evaluated? And then finally, is there a offense or defense trigger attached to the end of the model? And so just to kind of build on some of the points that have been covered so far, and when we look at the model inventory on the system, the thought behind everything that we put up on the FSM model suite, from our perspective is, are these managers that we can trust, that have a long-standing track record, that are relatively predictable in the management style that they're advertising, and things that again have a reputation behind them that you can feel comfortable taking to a client or taking to your compliance department and being able to present it with confidence. So in the example that we're going to work through for our test case here, let's say we have the name the American Funds model, right? So we have FSM American Funds, which would be our model inventory. We have the number of holdings. In this case, we have 5 holdings. Alternate models may have 2 holdings. Moving forward to our evaluation frequency, we have M for monthly or S for seasonal quarterly. And this harks back to what Steve was talking about with regard to playing these seasonal periods in the market, which will occur from an evaluation standpoint in February, May, August, and November. So a little bit different than the traditional calendar quarter. We do this for a few reasons. As mentioned, looking at playing those historically strong or weak seasonal periods in markets that we've tended to see in the past, but also to give you a differentiation with regard to how you communicate this to your clients. When most people, most management teams or portfolios are updating on a calendar quarterly basis, you can come in at a different time of year and have a different time to talk to them, right? It's a new opportunity for a touch point. It's a different story. It also has benefits in terms of avoiding those modern portfolio theory rebalances that occur on those calendar quarters, and most notably avoiding the December tax loss harvesting that we often see active managers partake in. So we're staying away from the herd in a sense, and we're giving ourselves a different talking point on that seasonal quarterly basis. Some of the models on the suite are going to just have these first 3 steps. However, a number of them will have what's called a cash trigger or an offense-defense trigger. And these triggers are going to be broken down by their acronym with respect to what they are tracking on the back end of the site. And I don't want to spend too much time on that now because we're going to wrap up with a more detailed view of the offense-defense triggers. But these are the range of different offerings that come with the models. One more thing I want to add on this, we talk about the construction of the models before we actually get into a couple of different examples. We want to make sure that, again, we're using high quality, highly vetted opportunities for you all. And so everything that comes out on the suite is going to be thoughtfully considered and really looking for an applicable use case, right? We're not just trying to throw stuff up there just to have it. And so with that, Ian, I'm going to pivot over to you, and we're going to take a look at the equity dominant models on the model platform. But first, for those of you at home, if you are following along and you want to get to the models page, you can go to Models and Products, Models, and then from here, if we click the Filters button on the left, we can check FSM, and we'll filter down to all the fund score method models. So over to you, Ian.
Wonderful, thank you there, Eric. And so that FSM model guide is a great reference point to come back to maybe We'll go over most of those concepts, most of the examples that we're touching on there today. But in terms of a reference point to come back to, maybe over the holiday weekend, or maybe if you're looking to dive a little bit deeper with the client, as Eric mentioned there, that's always going to be available there on the back end, or on the resources tab under prospecting, for you to use as you see fit. So when we're diving in here to the models page, as I mentioned earlier, we have a variety of different models that are available, and FSM is some of those models that you have presented there for you. As Eric mentioned, you would go over to the left-hand side of the page, click on that filters little pop-out menu item, and then navigate down to the FSM designation down there under methodology. You'll notice there's a variety of other filters that are going to be available for you to click on here, some of which are applicable to the FSM models and some of which are not. So just one thing to keep in mind, if you click on FSM and you're not seeing anything pop up there on your screen, these filters are actually going to remain static unless you reset them. So even if you log off and you log back in, they're going to remain with whatever you had previously checked off. So one thing to keep in mind when you're going through these different model offerings, just go ahead and hit that reset all button and then navigate back to the FSM if you're not seeing anything pop up there on your screen. So when we come into the FSM designation, we see a variety of models that are going to be included here. We're going to kick things off today by touching on some of the more equity-focused models that we have. There's a variety of different use cases that we can apply the fund score methodology to, really by nature of the flexibility of that fund score. And it's looking to take advantage of the strongest technical areas by nature of that scoring system. And so that allows us to use a variety of different asset classes or different classifications, different types of funds within the model inventories. So as we come in here, the first model we're going to take a look at is going to be the T-row price model. So you can either scroll down and click on it, or just simply type in, as we're doing here, simply type in T-row, and you can see the top model there on the page is going to be the FSM T-row price 5S TR 4050 model. So as Eric just went over, FSM simply letting you know, hey, this is a fund score method model, not a relative strength based model, just to designate that separately right off the bat. We then get into the inventory of the funds. So looking at T-row prices lineup of mutual funds there in our fund score evaluation. There's going to be 5 funds that this model is going to hold, and we're going to evaluate the inventory for the 5 funds on a seasonal quarter basis. So as Eric mentioned there, seasonal quarter, looking at the beginning of the month of February, May, August, and November. So we just had our latest seasonal quarter evaluation beginning of this month. And you can come in and see the holdings that we had following that evaluation here by clicking on the model and clicking on that holdings page as we see here in front of us. We can see that this model is definitely taking more of a risk-on approach following the latest model evaluation. We're looking at a fully equity-focused model holdings lineup right now, as you can see here by these breakdowns. So a nice thing about this models page, you can see, come in and see the funds that we're holding. Those models are going to seek to target an equal weight allocation initially. As it drifted a little bit here, if you want to target that back to the ideal weight, you can click on the toggle ideal weights over there on the left-hand side, and it'll equal weight each of the holdings in the model. And then let's say you wanted to come in and you wanted to go ahead and apply or see about investing in a particular model. You can enter in, let's say, $100,000 for that potential investment. Hit update shares, and then it's going to go ahead and tell you exactly how many shares of each model to purchase over there on the right-hand side of this page. So the idea being that you would come in, you would enter in your amount to invest, you go ahead and purchase the shares as dictated there by the model, and then in order to set an alert on this model, you can go over to the left-hand side, to the left-hand side of this page, but the far right-hand column of the model's listing page, and click on that little bell icon. If it is gray, you will need to click it on to click it blue, and you'll get a little alert updated notification at the bottom of the screen. And essentially what that's doing is it's going to tell the system to send you an email if there's a model change. So while we know when these model evaluations occur, right, at the beginning of each seasonal quarter, and then the potential cash trigger that could come into play, at least the evaluation is going to take place at the end of each month, while you know that the time frames around those model evaluations, it's definitely helpful as well to go ahead and set alerts on that model, so that way you are sure that you wouldn't miss anything there. The system is going to go ahead and send you an email if there's a change to the model, and then you would come in and make that change accordingly. What that change is going to look like, actually, you can see if you go over to the trades column in the middle option there on the models page. You can actually see all of the trades that have taken place for this model throughout the course of this year and throughout the history, the back-tested history that we have available here for the model. Clicking on any individual year will bring up the trades for that particular year. Again, looking at those model evaluations on that seasonal quarter basis. So saw quite a few trades for this particular model at the latest evaluation. Saw 4 funds moving out and four new funds coming in. But each of those can be taken, you can take a look at here for some historical perspective on where we've seen things moving around in the model, what's moved out recently and what's come in on a recent basis. In order to see the full universe, you would click on that universe designation there. And you can see that while we have currently fully invested allocation in those equity-related funds up towards the top of the rankings there, there's a lot of different kind of funds that we have in this potential inventory. And so the point to note is that those bolded funds that you see up at the top of the rankings, or at the top of this page rather, is going to be those funds that the model is currently invested in. That is going to be, those were the top 5 scoring funds at the beginning of the month. So we've seen a slight change in the top 5 lineup, but still everything included in the top 6 is certainly a positive sign to take, given the risk-on nature of this model. So you can see from here, from the T-row lineup, we have outside of the equity-focused areas, we go into some other areas as well. You see some bond funds included in there, international areas, as well as some potential funds for maybe alternative investments, whatever area that it is you're looking to invest in here, is going to be included in this T-row price inventory. And that is one of the beauties of the fund score methodology, that it can invest in any of these areas, right? While this model is equity focused now, you can see by going through the inventory, it definitely has fixed income related areas that are going to be included in the inventory. So if those funds rose to the top end of the scoring rank, if they had the highest ranking fund scores at the time of a model evaluation, then the model would transition over towards fixed income approach. It just depends on whatever's scoring the best within the particular model inventory. So that allows these models to be very flexible in terms of where they allocate to. Maybe more so than some other models that we have on the platform. In order to see an example of that, we can actually jump on over to one of the other more equity-focused models that we have, looking at the Vanguard lineup. So backing out of T-row, you can simply type in Vanguard up there at the top of the page, and you'll notice the top model that you'll see, the Vanguard 5SPR 4050. So similar approach, right? Still FSM lineup, still 5 funds, still seasonal quarter, and the same cash trigger. But now we're looking at Vanguard's inventory of funds instead of the T-row inventory of funds. Taking Vanguard's inventory, sorting them by that fund scores you can see, and moving over to the universe there. And we saw a little bit of a different makeup at the beginning of this month with this latest model evaluation. As we can see here by clicking over to holdings, this model is currently going to have still an overweight towards the equity side of things, with 3 equity-related funds included here, with healthcare, Vanguard Growth, and then the U.S. Growth Fund there. But it has 40% exposure to bonds, so looking at the total bond market and the government bond funds included there as well. So given that Vanguard's fund lineup's a little bit different, T-row tends to be that more risk-on, aggressive manager on the street. And we see Vanguard's a little bit different here, looking at a 60-40 allocation, a little bit more of a moderate approach than we see currently displayed here by nature of that latest fund score evaluation. And it's going to be different for each of the different or potentially different for each of the models that we have here on the system. Again, you would follow the same methodology or approach. If come in here looking to invest, you can enter that amount to invest, get this updated amount of shares, and go ahead and click on alerts on that particular model. You also have the ability here on this models page to view some more in-depth statistics that are going to be available. You can see here by going over to the stats page, you can get a nice breakdown of what the asset class breakdown between the funds is. You can go scroll down a little bit on the page as well to dive into maybe some further risk characteristics, looking at alpha, beta, your Sharpe ratio, upside, downside capture. These calculations are going to be available for every model that we have here. And so certainly a pretty worthwhile place to come in and take a look at if you're trying to decide which model might be best for your particular use case. And looking at another model inventory that we have here for the equities, or typically equity focused side of things, is going to be the one that Eric went over there that's going to be included in the FSM model guide, and that's looking at the American funds lineup. Again, this is going to be similar approach, just different inventory, all right? And so we can come in here and click on the holdings tab and see that the latest model evaluation we had for American funds presented quite a different picture than we maybe see for some of the other more flexible inventory models. Model still has exposure towards equity, but is looking at a 40% equity exposure and a 60% fixed income exposure, with 3 fixed income related funds and 2 equity related funds included there. So a little bit more conservative approach that we see displayed here by the American funds lineup. And that partly by nature as well, that American funds does have a tendency to actually raise cash within their underlying funds included. So that has led to a dampening of some of the scores from the equity side of things. But every model inventory is going to be different, and we see those changes are going to be reflected here in the score rankings on the inventory page. You can see again those top scoring funds that we had at the beginning of May are all bolded there, indicating that they are the current model holdings. Again, an expansive universe here from American funds, and definitely a more conservative approach that we see here displayed by nature of that recent model evaluation. But I mean, each of these areas are going to be potentially different, looking at different time frames, but are all potential areas to look towards in terms of that flexible nature of the fund score methodology, looking at potential to invest either fully equity or fully fixed income, or a mix of both, as we see here displayed from American funds. And there are a variety of other models that we have here from use the FSM approach, maybe in a more focused role. Is that right there, Eric?
It is. Thank you, Ian. And one thing, as we're wrapping up with some of these mutual fund models, at least for the time being, I want to point out this other related shares function. So we understand that many of you are allocating in different account styles and using different share classes. So if you are, let's say, following a model like the American Funds 5S, and you are looking to use an alternate share class that's outside of the A share, which is our typical parent or primary share class, you can then come to the universe of the model and click that other related shares button to get all the other share classes and expense ratios available. Additionally, you'll note that the score is going to be consistent throughout, and that is always derived from that parent share class. So with that, we are now going to pivot over to some different types of models, and we've talked about equity dominant, as we call them, the mutual fund models, including T. Rowe Price, Vanguard, and American funds, which will generally be equity focused just based on their inventory and based on the history of said inventory. But I think one of the misconceptions about the FSM framework is that it is only applicable to mutual funds, and that is in fact incorrect. Some of the, in my opinion, the best offerings that we have on the FSM suite are designated toward ETF only inventories. And the best place to start with that would be to come and look at our core solution lineup. So the core solution concept is revolving around using highly liquid, well-followed ETFs within a US core or an all-cap world framework, and then using the fund score methodology on top of that inventory to find strength and avoid weakness in those inventories. Beginning with the core solution US model, and I'm going to select that one here, this PR4050. Notice we have the number 2 for the number of holdings included in these core solution models. That's going to be consistent across any of the iterations that we have here. In today's current framework for the U.S. core, we're showing QQQ Trust and NTUM as our split holdings. And if we pivot to our universe and we look under the hood at what is really driving this model, we see that we have a pretty simple inventory with this core solution US model. And that's not to detract away from the power that that simple inventory can benefit from. In fact, I like to equate this to having the ability to know, whether you want it to be in the growth side of the style box or the value. And of course, we're not necessarily as style focused as that, but if you were to apply that to a core framework and then say, okay, let's lean into those directions, it really gives you the opportunity for outperforming what has been a tough benchmark to beat in the S&P 500, right? We know that if we were to consider the S&P 500 as the core, right, for domestic equities, that, in many cases, if you're a money manager, it has been an uphill battle, right? Very, very difficult to contend with that core, that benchmark. So we designed these models to do just that, right? And give you that flexibility of the fund score framework while being able to tactically shift around to different core-centric ideas. So noticing the other available funds within this inventory, we do have the core itself in the form of SPY. We have the more, I guess we could say, blend value tilt of the Dow Jones Industrial Average ETF. We also have low volatility, and then we have the equal weighted S&P 500 fund included in here as well. So again, very, very simple, but a great building block for your core equity exposure. With the ETF models, as I mentioned, exposure, we do have a unique tab here where you can click and see the underlying holdings and determine what the weighted average for said holdings is on that overall portfolio. So this is kind of a nice feature if you wanted to be able to show clients where they're invested from an individual stock perspective, and then further you can hover over each ticker and see the exposure that's derived from each of those included ETFs. With regard to that core solution US, we have a seasonal quarterly model as we're looking at here, as well as a monthly model. And both follow the PR 40/50 offense defense indicator. And when we take that core solution concept and acknowledging that this again is somewhat of a simple building block, in a sense vanilla inventory, and we expand it out a little bit, that's where we're going to look at the all cap world lineup or all cap world framework. And it takes the same concept in using broad market, highly traded, low cost ETFs, except in this case, we're going to expand our potential size and style box exposure, moving from more of a large cap core focus that the US core models employ to, a varied approach in that we can go a little bit more granular on that underlying exposure. You'll notice there are different size and style category funds within here, as well as international funds. So we really, again, expand this inventory to give you the best opportunity of finding those pockets of strength within the core equity market, not only in the US, but also around the world. And I think that that's a really powerful tool because we know based on our relative strength readings, whether you're looking at asset class group scores, which uses the fund score concept, or if you're looking at Dolly, that international equities is very weak right now, right? So having a model that's able to avoid international equities unless they come into favor, say as they did in the mid-2000s, right, which was considered the lost decade for domestic equities. On a back test, this model moves into international and gives you a foot to stand on from an allocation standpoint abroad, right? So that can be, in my opinion, one of the hardest decisions to make, right, in determining that international exposure. So let relative strength make that decision for you. Another thing to point out here, and we may have glossed over this, money market is also a constituent within these model universes. And we do that by design, right? We want to be able to have not only the offense-defense trigger that we're going to cover in a little bit in further detail, but also we want to have the ability for money market to compete against everything else in the inventory and work its way up, should it be a dominant factor. You know, as an example for when that takes place, we have an additional version of these models that focuses solely on the international lineup, core solution isolated international core. And this is for those of you who are looking at, you know, solely international exposure, right? Which, as we've acknowledged, has been a tough place to be. And interestingly enough, money market has moved, you know, pretty well up into that ranking scheme here. So, you know, the model at this point, based on the last evaluation, is actually 100% in cash. So, you know, again, solutions for domestic equities in the U.S. core iteration, all cap world for that flexible, dynamic, global exposure potential, and then the isolated international for your core international pieces, should you choose to be invested in there at all times. So with that, I guess one more thing I want to throw in, because we didn't have this on our notes, but we also do have a First Trust self-direct ETF model. And this is going to be very, very similar to some of the models that Ian covered in terms of T. Rowe Price, American Funds, and Vanguard, and that the universe is what we consider equity dominant or go anywhere. The First Trust model here is unique in that we do include a little bit more sector exposure underlying. So you'll notice some of the funds here in the top are sector focused, but it is going to be very, very similar to, you know, again, how those equity dominant models work, but using the ETF vehicles from First Trust. So with that, we'll pivot over to our fixed income offerings.
Wonderful, thank you, Eric. And so in order to navigate to the fixed income area, again, you can just go back up to the top of the page there and simply type in just fixed, and that will gravitate you towards those fixed income FSM models that we have here on the platform. One point to keep in mind here is that, again, these models are going to be looking at particular inventories of funds from different providers, looking specifically at Franklin and Pemko. So we have two models for each of those providers, one that's evaluated on a seasonal basis and one that's evaluated on a monthly basis for each. So right up at the top of the page, you can see FSM Franklin fixed income, the 2S PR 4080. So again, looking at the Franklin fixed income inventory, looking at holding two funds evaluated on a seasonal basis, and using a slightly different cash trigger than those that we've seen here thus far. We have PR 4080 instead of the PR 4050, which essentially just means you need a stronger money market in order for those models to move to cash, because we typically see, as we typically see when we have maybe a rising, stronger cash position relative to the rest of the field, that we have tended to see fixed income move higher in relative rankings as well. So just making it a bit harder for those models to actually move out of fixed income into 100% cash as an example. But when you come in here, again, you're clicking on the holdings will give you those two particular holdings that the model is going to hold here right now. Looking at the U.S. government securities, the adjustable U.S. government securities, and then the U.S. government securities fund. Clicking on the universe again will bring the fund score breakdown for each area that's included in this model inventory, and you can see there that we've seen a little bit of score movement at the top end. But still, those funds that are going to be included, maintaining that ideal score above 3.0 is definitely an important thing to keep in mind. But another area to look towards is we've seen, if you're looking for further return information, one area that I don't believe we've touched on here just yet, each model is going to have a returns tab there in the middle that's going to include a breakdown on the model return as well as the benchmark that we're using there, that VBI or VBMFX fund, looking at the model and the benchmark return, and then we'll provide an excess return for you over on the right-hand side. And so while, I mean, we can see the model has underperformed its benchmark with the broader volatility that we've seen in some of the fixed income space there with earlier this year, we can go back and see that typically the excess return is going to be more towards the positive side and benefit there of the model. As you can see, this model was incepted there on July 10th, 2018. And so anything prior to the inception there of this particular model would be underneath that black line, but still going to be a similar methodology. So when we're looking back at the back-tested returns or the back-tested performance there of the model, it's applying the same model, the same approach that you're going to see here displayed for the model now, just in looking at historical return information to get at that back-tested information there. So again, you can come in here, click on the holdings, enter in that amount to invest, and update the shares accordingly. You can also do the same for the Pemko model, which you see displayed directly beneath the Franklin. We see that model have a similar approach, partially looking again with Pemko's lineup of mutual fixed income focused mutual funds, or rather income focused funds there. Looking at holding 2 funds, again evaluated on that seasonal quarter basis. Currently with exposure to the government securities fund and then that real return institutional fund there as well. You can go over to the universe tab to see that breakdown displayed there. A little bit more in depth and more variable areas from Pemko that we see, more funds included in this model inventory here. Then we still see those areas that we have exposure to in the model up towards the top end of those respective score breakdowns there as well. So these are going to be the more fixed income focused areas that we have. Also the monthly models will be evaluated in a couple of weeks here at the end of the month. But again, so seasonal quarter and monthly models available for Franklin and Pemko. And as a quick aside too, we did have a question pop up here, and as an aside on that, if you do have any questions, feel free to go ahead and shoot away those in the Q&A feature throughout the presentation, and we'll do our best to answer. One of the questions that we did have was can you allocate to multiple models? Maybe if you wanted to apply some of the core solutions models that Eric just touched on, as well as some of the more fixed income focused models in a static allocation to each particular asset class. You can definitely do so during that, using that allocation column on the far left-hand side of this page. So if you had back on the broader FSM page, you would be able to enter in an amount for each of those particular models you were looking to use, and then run an allocation from there as well. So just a quick aside there with the question we saw pop up, and wanted to note as well, if you do have any further questions on anything that we're covering as we continue the presentation, please do use that Q&A feature. So with that, I think we were going to jump over here to touch on some of the other areas looking at the variable annuity space.
Yeah, absolutely. Thank you, Ian. And, you know, again, for those of you who are asking questions in the Q&A box, we will do our best to make sure we get to them throughout the presentation. And if not, we will stick around at the end to answer all of them. With regard to the variable annuity space, you know, for those of you who are now well set up with the fund score concept, you're probably thinking, okay, I can apply this elsewhere, right? It doesn't have to just be in the model framework that we've established, but anything that's using fund score, anything that's a mutual fund or an ETF, you know, I can start thinking about things in that FSM framework. And so we did just that with the variable annuity space. We know that a lot of folks are using VAs, whether it's for the tax deferral, or whether it's with an income rider attached, or as a prospecting tool for clients in terms of looking at older VAs that are outstanding from other outside money and being able to articulate why they should transfer that over to you. We wanted to give you the tools to do that. And so what we started to do was think about what are some of the variable annuity products out there that are not only popular with you all, but also are really well set up for using this fund score framework. And a couple came to mind. Notably, we started this idea with the nationwide Jefferson National lineup, and this is kind of our trailblazer into the space. We're looking at a really extensive list of sub-account proxies, and you'll hear me refer to that as I talk you through the VA concept. We do call them sub-account proxies because a lot of the sub-accounts that are used are white label funds, right? Whether they're custom offerings that there really isn't public price data for. We have to be conscious of that in making our proxy recommendations to you all. So in many cases, we're going to use mutual funds that are the same fund manager or same strategy, just under a slightly different name. So for example, like the American Growth Fund might be the American Growth Insurance Fund, right? So we have that in place for our recommendations. And also you'll notice on the back end for a lot of your variable annuity or 401ks, which we'll talk about in a second, many of those sponsors are going to have index-based products. So something like, say, for example, the BNY Mellon S&P 500 index, right? Well, we're pretty confident that that is the same thing as SPY, right? Or Vanguard S&P 500 index fund. So we can then take that and apply it to a fund score framework. And so in doing so, we've expanded the nationwide concept to the Jackson Prospective Elite Access Variable Annuity, which is using a combined common inventory between those two popular VA chassis and giving you the ability to have a coherent management strategy for those sub-accounts. So, with regard to those lineups, they're going to be very, very similar to what we looked at with the equity dominant theme, right? We try to make sure that when we do our due diligence in including those sub-account proxies, that we're making sure that the inventory is balanced, meaning, equity leaning, but also giving you the ability to go into fixed income or play defensively should you need it. Right now, we can see with regard to the Jackson model that we are showing a little bit more of a moderate risk profile with give or take a 60-40 allocation. We then took that same concept and we looked at the Lincoln Choice Plus and then the Lincoln American Legacy, which Lincoln Choice Plus is going to be very similar to the Jackson in that you're getting a significant sub-account proxy diversity in terms of different fund providers. The American Legacy was kind of a fan favorite that was inspired by you all asking for a way to have access to this more legacy item with regard to the Lincoln lineup that only uses American fund proxies. So we put this out there again. We want to think of ways that you can add value to your practice. In the future, we are looking at ways to enhance the sub-account proxy labeling. So keep an eye out for that. We're always open to your suggestions and feedback when it comes to exploring these more niche areas of the fund market. So Ian, I mentioned 401ks. Do you want to cover a couple of examples that we put together here just to get people thinking about the 401k space?
Certainly. Thank you there, Eric. As we've been discussing here, we've gone over most of the different kinds of models that we have here in using that fund score methodology, all centered around different kind of use cases, right? Whether it's use cases there with the variable annuity space, sleeves you're looking to fill within the core solutions or potentially fixed income models. But another use case that we have is looking at 401k lineups, right? Whatever we're going to have this particular 401k lineup of funds that you would potentially be able to invest in, and each of those funds are going to have a fund score on our system. So that's another use case. You can come in and use that fund score methodology on a particular 401k lineup, like the ones that we see here displayed in front of us. So these three areas, the FSM, Nasdaq, First Trust, and Morningstar 401ks, are actually the 401k lineups from each of those particular companies. So Morningstar's 401k lineup that you see down there that we have highlighted here is looking at those funds that are available to Morningstar employees, actually looking at their 401k lineup, coming in here, throwing that into our FSM model approach, and then running an FSM model accordingly. And these are all looking at the particular 401k lineups from each company, looking at holding 5 funds and evaluating on that seasonal quarter basis. We can see here that the approach from Morningstar is going to give us an overweight towards equity at about 60%, with about 40% fixed income exposure there within the Vanguard Total Bond Market Fund, as well as that Pemko Real Return Fund there on that income side of things. But different 401k lineups are going to present some potentially different allocations. By, for example, looking at the Nasdaq 401k lineup, which is with Dorsey Wright now, the 401k lineup that we would have available there. You can click on the Universe tab. You can see that has more of an equity tilt with 4 equity-focused funds and 1 bond market fund included in there as well, giving you more of the overweight towards the equity side of things. It just depends on those funds that are going to be included in the 401k lineup, and each might be a little bit different. So this could be another route to come in as well for you to, if you have a particular inventory you're looking to include, of maybe applying some of this fund score methodology through in your own approach could be a route to go with there if you're looking to come in and utilize this methodology here, looking for those top scoring funds at those model evaluation points at the beginning of each seasonal quarter. So another potential use case to come in and apply this fund score methodology to. And that will touch on, now we've touched on most of the different breakdowns and different approaches that we can apply this fund score framework to. And so what we've done now is we've taken many of these different areas. So as we touched on, some models are very flexible in their potential allocation. Some have a potential just an equity focus. Some have more fixed income focus. Those different flexible models are going to be fluctuate in terms of their allocation towards different asset classes. And as we've touched on here, you do have the ability to come in as well using that allocation column on the far left-hand side of the page and set up your own allocations to whatever models you're looking to use if you'd like to. You can enter in that custom allocation on the left. Let's say, as we see here, we have 50% exposure towards the core solutions and 50% exposure towards the T. Rowe Price. You would have a similar approach as you were looking to do with the holdings. You enter in your amount to invest and then allocate the shares accordingly. Another route that we can come in and have, though, this brings us back to that idea of the model of models. It's essentially what you're creating here, right? And so one of the more recently initiated frameworks that we've had is bringing this model of models framework to an actual model that we have presented here for you on the page, looking specifically there at the tortoise and hare model. And as the mastermind behind the whole fund score system in and of itself, Steve brought this concept to light here, looking at the tortoise and hare approach. And so we'll throw things on over to him to talk more about how we can apply this breakdown and allocations to the master model that we have here provided for you.
Thank you, Ian. I want to have a preceding sentiment is we've covered a lot of models today, and the fund score method is applied to each model. But I want to make a kind of a sentiment here is that the idea is not to alter the great shops, the American funds and the T. Rows, and alter what they do best. The idea is to provide some guardrails and some relative strength rotation without altering the essence of the shop that we're working with. So one idea is we don't want to turn T. Rowe Price into an American funds, and nor do we want to turn American funds into a T. Rowe Price. We want to be certain that we're maintaining the essence of what they do so well. That evolution of that thought is rather than try to make one shop act like another shop, the idea really will be, how can we blend 2 great or 3 great or 4 great type of investment approaches into one master model. And that's where the tortoise and the hare came from. Of course, to explain, there are tortoises out there, kind of conservative managers. They've got a great track record of what they do, all the way up to the hare, which would be more of that focused, active manager, putting the pedal down on the gas, a little faster, a little more racy, which is what we want. And so the tortoise and the hare is an example of combining several approaches together at particular percentages to give an experience, experience of excellent capital appreciation, but you still have that conservative approach. You have a blend, or you could say a strategic blend, which a normal cruising altitude is about an 80-20. But the idea is that we want to put together a master model that can handle a lot of money. In other words, you can put high net worth clients, all your high net worth client books on top of these funds. They can handle them. And you've got these exceptional sub models underneath, doing their job. Like the U.S. Core's job is to find the best form of the S&P 500 to be in and stay in the U.S. Whereas All Cap World, it can branch outside the U.S. if need be. And that's true with T. Rowe and American funds. They can branch outside or inside the U.S. as need be. And so it gives a high flexibility as to that type of strategic allocation that is the end result, but still confine this whole master model, to an equity part and a dedicated fixed income part, so that you can compete with this as a strategic piece in the high net worth, game, the game field. So I do think that you ought to study this model. I've had a lot of great feedback from those using the model, but certainly if you choose not to use a tortoise and the hare, you would study it monthly and quarterly to see and experience those changes, whether they be significant or subtle, to help give you confidence of how these models work together. Keep in mind at the genesis of FSM some years ago, the idea is that they would plug and play with each other, that you could go on the shelf and you could pull out the type of experience that you're looking for, whether that's more conservative or more aggressive, and you could blend them together yourself. So this is a living example of that you would do, I think, well to, keep an eye on and certainly use whenever you can. Back to you. Thank you.
Oh, wonderful. Thank you there, Steve. And I mean, we have this potential use case available here for you, included there with the other models. There's also a framework, as Steve mentioned there, that you can use and kind of apply in that model of models mindset, potentially using that allocation column there on the left-hand side of the page. Again, getting at your own back test and running from there accordingly. Now, as we're looking to wrap things up here, coming up on the hour mark, I'm going to spend a little bit more extra time on one of the areas that we intentionally glossed over at the onslaught of this presentation, looking there at the different cash triggers that we have available. So there's really 4 main potential cash triggers outside of the money market inclusion in each model inventory. As Eric touched on there with his specific example, looking at that isolated international model, we saw money market rise to the top end of those score rankings to move that model to 100% cash. So each model has the potential for that to occur as well, but is something that we see occur very kind of infrequently there. I guess more outside of the international space specifically, but looking at the broader models, something that doesn't occur all that often, but definitely can occur. Each of the models as well, if they have a separate acronym after the 2S or 5S or M designation there, either MMPR 50, MMPR 70, PR 4050, or PR 4080. Those are going to correspond to separate cash triggers that are going to be associated there with each model. And what these cash triggers are looking at actually is going to be here on the asset class group scores page, looking specifically at the ranks on the left-hand side. So you can come in here, we see money market percent rank currently listed at 35.92 as the yesterday. And then we have U.S. equity core percent rank currently listed at 85.21. So when we're looking at those 4 potential cash triggers, MMPR 50 and MMPR 70 being those first 2, those models are going to correspond solely to the money market percent rank, and are going to, each of these cash triggers are evaluated at the end of each month. So what they're looking at is coming in and saying, okay, the money market, what was the money market percent rank at the end of the month? And what that rank corresponds to is looking at the 135 different areas we have on the asset class group score system that we did touch on there last week, and looking at U.S. money market as one of those groups as our cash proxy, essentially looking at, okay, how much of our investable universe out of these 135 different areas, how much is cash beating, right? Currently we see it at just over 35%. What the models are looking for is coming in at the end of each month and saying, okay, for the MMPR 50 models, if cash is beating 50% of your investable universe here through the asset class group scores page, then those models with MMPR 50 will move to cash. If the MMPR 70 models will look at, okay, if cash is beating 70% of your investable universe here on the rankings, then those models will move to 100% cash. PR 4050 is going to be a little bit different, looking at the breakdown there for the money market percent rank as well as that U.S. equity core percent rank. And we use the U.S. equity core percent rank for the S&P 500 index funds group that you see here up at the top of these rankings. Again, looking at, okay, how much is your core equity market beating? For the PR 4050, we need to have the core equity market fall out of bed as well as the money market rising in the rankings. And so for some further perspective on the movements that we see here on these rankings, and how we can apply them there for the multi-trigger or the dual factor trigger rather that we have there. We're going to have a bit of a presentation here that we're going to throw things back on over to Steve to touch on why we're looking at these different cash triggers.
Yeah, and keep in mind that what you're looking at now is the core percentile rank. How strong is that core U.S. market as represented by the S&P 500 type of constituent related funds. And what we're after there is to find out the market type that we're in. What you'll notice is historically, and of course we're only showing so many years here, but historically the core of the market goes through very strong phases and then somewhat very weak phases. If we look back and click on this graph here, you know, to the left of the graph is more of a weak phase that we had in the what they call the lost decade, you know, the 2000 up to 2009 time frame, where the core of the S&P was very low. And these kind of markets, you know, strategic allocation that your firms may offer, or you're working with large caps, these types of low core dominance markets work against most strategic allocations, and they certainly work many large cap type of strategies. I call this an important zone to remember, because if we get back into one again, you have a high alpha potential for yourselves, meaning your associates at other firms don't know what kind of market type they're in. They don't know they have to go ahead and rotate to other asset classes, or they don't have models that on a relative strength basis rotate out to other asset classes other than, you know, US large cap. And that gives you a great chance to do some massive outperformance. So, you know, you have a high alpha potential, but your strategic allocation that you're working with your firms on, that has a low potential of doing well, simply because the core is not dominant enough. And these are markets we look out for, because we have to be, you know, correct. We have to be right on time with the idea of identifying a low core strength market. Now, contrasted to that, over the last, you know, 10 years, you know, we've been in a high core PR market over towards the right of the chart. And that's where the core of the S&P has a dominant factor, you know, over the other asset classes that might be, well, in the world, but that might be in your strategic allocation. And these kind of markets, the strategic allocations that, you know, most firms might recommend do much better, because they have that large cap component that rides the tide well here. The ability to outperform the market benchmark is a little tighter to be able to outperform that, because in a high core dominant market, there's fewer groups that can add that alpha, although they're there. And your models are going to like pick up things that are going to be in a high performance mode. But the you know, the cushion to easily outperform the S&P, it's not so easy. But that's why you use relative strength, and that's why you use models. So these are the kind of the two broad market types in the core that we look at. And depending on what market type we're in, you know, can impact the offense defense component of the model. Let's go to the next slide. You know, as we move on, you know, to look at money market, this is a money market graph. It will show periods of high money market levels, which are very defensive, very turbulent markets, and that will give you, you know, a potential OD warning, offense and defensive warning, that there's high turbulence and cash is pretty important. But through time, you know, the money market will have some episodes of spiking here or there, but we do go through periods of calm. If we keep clicking through this graph, you'll see that, you know, you can have several years of a low money market reading. That's normal turbulence, that it does spike around a little bit, but generally maintaining itself in the bottom half of the football field, or even lower, which is really a blue sky scenario. And currently, to the right side of the graph, as you can see, we just went through a little spike in the money market, where it peaked up above the 50% level for, you know, a few days, and then it's retreated back down into the bottom half of the field. But that story's still unfolding. You know, obviously we're still in 2020. We're still in the COVID-19 type of era, and that remains to be seen. But to give you, you know, an overview, you know, the money market will spike along the way. Typically, the money market will spike over 50 far more often than the core will dip below 40. And what that would mean is that, as we move to the next slide, is that we put the combination of the percentile rank of the core and the money market together in order to get the model in shape to handle, you know, kind of long-term markets where We only want to go into a full-blown defensive move under the right scenarios. Otherwise, we want to hold on zones and then get that better performance, which his history really dictates that that's the way. You got to accept, you got to do that. You got to take on some turbulence, to get the better long-term returns. Now, starting from the left of this chart, as we click through, we can see that, in the 2008 timeframe, there was a pretty massive money market signal high, and the core fell apart, well below the 40 line, which is the blue line on the graph, and then spent some time at amazingly low levels. And that's exactly the kind of market we're trying to avoid, where the core strength is not there, can't help us in any strategic way, and the money market's too high and things are too volatile to even touch. And so, the PR 40/50 model steps to the sidelines, trying to protect the T. Rowe Price, protect American funds, protect the core solutions, because the market environment is just untenable. But, you come out of that area, the core re-inflates, the money market drops, and now we're back on to letting the managers do what they do and let the FSM models do what they do, and that is ride these other markets. But along the way, there have been some strikes in the 2015 area. The core did dip, just to about the 50 or below line, did not pierce the 40 line though. But the money market did spike to pretty high levels. But in this context, the PR 40/50 model is taught to ignore, biting on that turbulence and becoming too defensive. So we ride through that turbulence, to get the better return. A few years later, in 2018, we ran into the same issue. A massive bond market failure led to, and there were other equity failures in relative strength, led to a massive move by the money market indicators, spiking pretty high. However, the core still maintained a respectable level, up in the mid 50 and 60 areas, showing that, it still had the grip. And so we still hung on. So a PR 40/50 model would ride through this turbulence and hang tight with this. Now, when you look at today's market, you could say if this is all we were going to see, well, then that's on the far right of the chart. As we click over there, we've had a core move down slightly. We've had the money market spike up and then start to abate back down, but we've had no PR 40/50 trigger. So the point is that yes, a very turbulent and psychologically scary time, and you could say so far, but not enough to cause the equity core of the U.S. to lose its grip on that control, and certainly not enough distress amongst all the asset classes to cause money market to rise to ultra high levels. And so again, working as designed, whereas the PR 40/50 has not triggered at this point in 2020. And, and that's why we monitor the indicators to see, if there is a trigger point. So what an FSM model will do is it will ride through the years and the decades, and some turbulent zones it will pay attention to and go to defensive posture, and then some or many it won't. And this is normal behavior from a PR 40/50 model to try to hold on to, even though turbulence can be high. And I think those are some of the things that you need to remember, that we're going to experience turbulence. Certainly we're going to experience turbulence in the future, but not all turbulence means we go to defense. So from an OD or an offense-defense point of view, these indicators are guarding the models. Keep in mind, under the model, in the model, relative strength rotation is defense, meaning that, I bought more bond funds or I bought less bond funds. That's happening inside the model, regardless of these offense and defense indicators we just covered. And so there's this sense that by being in leadership in the relative strength, that in itself is defense and offense properly mixed. So you have really two layers, several layers of offense and defense. And we wanted to make sure that we covered some of the schematics of the PR 40/50 and explain, why it reacts to some markets, why it doesn't to others. But certainly that core percentile rank is a driving force that we anchor onto. And here we are. And so we just do what we've been doing. We move into the future. We know where the indicators are. The models read them at every frequency. and that's the game plan you share with your clients. I appreciate the time to explain or go into detail on these indicators.
Wonderful. Thank you both. And thank you very much to everyone here that has joined us this afternoon for the webinar covering there's various different FSM models that we have and how we use that fund score approach within them. Obviously, there's a lot of content that we have touched on here this afternoon, and we do apologize for going a little bit over the allotted time. A couple points that we did want to highlight here, housekeeping items. We did get a couple questions around not being able to see the FSM models anywhere on your page. So if that's something that happened to you, if you were looking to follow along, it's likely nature of the FSM models are only going to be available with the enhanced security selection, the ESS research package. There's a potential add-on to some subscription levels. So if that's something that you're interested in, please reach out to us here. And as well on the broader approach, if you have any further questions on anything that we touched on here today, or anything around the fund score approach in and of itself, we are still in the work from home environment here on our end. I think some of us are going on our 11th week now, I think, doing the virtual nature of things. So definitely had ample time to get used to the work from home environment, but we're definitely still around and still more than happy to help out with whatever it is you may need. So part of your Dorsey Wright subscription does give you access here to us, to the analyst team, to help out with any questions you may have, whether they may be fund related, looking at how a particular fund is scoring, or taking a deeper dive into some of this methodology that we've covered here today. Feel free to reach out to us there. You can give us a call at 804-320-8511. And if you would like to reach out to us there, maybe via email, rather type than talk, more than welcome to shoot us an email at dwa@dorseywright.com. So with that, we'll go ahead and wrap up things here this afternoon. This webinar is being recorded, and we will be sending out a recording to anyone who had registered there for this presentation. So I want to thank everyone very much for joining us here this afternoon. We will be having the last iteration of our ESS webinar there next week. It's going to be next Thursday at the same time slot at 1 p.m. Going to be focusing on the Team Builder tool. So we thank everyone very much for joining us here this week, and we look forward to having you back next week.